Hey everyone, so it's basically inevitable with this pandemic and all this economic collapse that's going on right now in the world. Eventually the stock market is going to crash, or we're going to see some kind of price reduction in the stock market massively, I imagine. After this happens, a lot of valuations on some companies will be a lot cheaper, and during that time when everyone is scared, is usually a good time to buy. If you're smart and not scared, you can pick up some great companies at some great prices. So with all that being said, today I'm going to cover 3 stocks that are currently too expensive, but if we see the stock market crash and these ones fall with it, I am 100% thinking about picking up and loading the boat on. These are 3 stocks I've got on my watch list, watching very closely. If they go down, I'm looking to buy them. And if you want to watch how I go with these stocks eventually, you'd probably subscribe to see more of my content, yeah? Leave a like as well if any point during this video you enjoy the video and you learn something from it. Tells YouTube that you like this kind of stuff, and that helps me out. Alright, so let's get into the first stock. The first stock is Beyond Meat. Ticker symbol BYND. Sitting right now as at recording this video, I'm recording it over the weekend, $91.53. Now, what is Beyond Meat stock? Beyond Meat is a company that makes environmentally friendly plant-based substitutes for meat products. And if you look at the numbers, or if you see anything, we obviously see an increasing trend in people going to vegetarian diets or eating less meat, just because it's kind of the hip thing to do, as well as it is environmentally friendly. It's really the only stock that you can buy to get into this space, so I would love to buy it if the price went down, for the reasons that I just said obviously, and for further reasons that I'm about to get into. So if we have a look at this right now, Beyond Meat is around about a $6.1 billion company. That's quite small for, I guess, a public company in the stock market. Obviously, $6.1 billion to you and me is a massive amount of money, but the total worth of a company, it's quite small for a public company. But I need this one to fall quite massively, I'm going to be honest, as it is very overpriced right now. We can see that forward PE on Beyond Meat is over 217, which is just ridiculous. And if you're wondering what a forward PE is, it's pretty much the stock's current price divided by its predicted earnings per share number for the next period. Earnings per share is pretty much usually abbreviated to EPS, so I will call it EPS from now on if I mention it again in this video. And EPS is simply just what it is, the company's net income divided by the total shares out there, so it's the earnings per share. So forward PE is the current stock price over its expected earnings per share. It's used as a valuation tool to help you value a company, or what you think it should be valued in the future, or how much growth you think the company has, really. It's a good tool to use. We see the average in the stock market right now is around about 20-25, I would say. And like we said, Beyond Meat is at the 217 PE, which is ridiculous. Now, it's not exactly fair to compare Beyond Meat with your, I guess, well-established normal company in the stock market, as it is quite a small stock that has a lot of growth still. Usually businesses that have higher growth tend to normally have a higher PE, which for example, I think if we look at Tesla, it's got around about 120 PE or so, I believe. But when in saying that, even I think 217 forward PE is still too high for Beyond Meat, in my opinion, for me to buy. And that's really the main reason that I don't want to buy it, because the stock's just simply too overpriced. Because this company is focused on growth and is trying to grow fast more than anything, and we can see that they have been taking losses while they've been a public company, but these losses are getting less and less every single year. We can see Q3 2019 they did make a small net profit, and we can see in their revenue numbers that revenue is increasing massively due to them focusing on higher growth. If we have a look at their balance sheet over here, their balance sheet is pretty terrific, to be honest. They've got $403 million roundabout in current assets, and they only have around about $20 million in long-term debt, which is what I love to see. Now, we'll see if this pandemic situation keeps going on, how that's going to affect Beyond Meat. I don't think it'll affect Beyond Meat too much, to be honest, because, you know, at the end of the day, you can still walk into a supermarket and buy things. So you can still walk into a supermarket and buy some Beyond Meat products. We'll have to see how it all plays out. But I'm thinking if the market does have some kind of crash, which is at this point in time, it's pretty inevitable that it will eventually, I think we will see a few stocks fall with the market, Beyond Meat hopefully being one of them for me. Now, if we have a look at the stock chart, where do I need it to go down to for where I can start buying? To be honest, I'm going to need it to go back to where it was around about at the start of April, where it was just below $60 before I can even consider to buy any of it at all. If it goes a lot lower than that, you know, I'm going to start buying a lot more, but I'm thinking right now it is pretty overbought because, like I said, it's the only real opportunity in the stock market on your plant-based foods industry. So I need it to go down a lot lower before I'm going to start buying, to be honest. Like I said, at least under $60 before I even start nibbling off some shares at all. But that's the first stock. The second stock that we're going to get into is Starbucks. The ticker symbol is SBUX, SBUX. Currently sitting at $73.79. Come on guys, you already know what Starbucks is. It's coffee stores where they sell very overpriced coffee to people that are willing to pay that much for it. You know, they have coffee stores pretty much everywhere, and due to the whole pandemic going on, their business is probably going to be massively affected. I have heard in the US that they have to be closed down completely. They are trying to get some kind of takeout situation sorted. I know coffee shops in Australia right now, you can just get a coffee to take away. Not 100% sure about Starbucks in America right now, but there are some Starbucks in Australia here also. I haven't done a whole lot of research on the stock yet, but I gather that they're in Europe also, but their situation is going to be massively affected due to the whole pandemic right now. Now, Starbucks is not as high growth of a company as, say, Beyond Meat because it's, you know, a lot larger and a lot more established already. But if we have a look, they are very profitable here with $3.6 billion net income last year, which is a pretty big number. And we can see first quarter numbers this year are down 50% year over year. So from first quarter last year, they are down around about 50%, around about $600 million in net profits Q1 last year to $300 million or so Q1 this year. And obviously this is because of the pandemic. So you'd look at that and say, okay, their net income's bad. That means surely the stock price is coming down. Their forward PE ratio is pretty bad, right? Nope, you're paying for a forward PE of 43 on Starbucks. What the heck? That does not make no sense. That is way too expensive for Starbucks in my opinion. Why would you pay around about that 45 number when you can get Facebook at like 23, where Facebook is going to grow a lot more than what Starbucks is? I can bet you that. It just doesn't make any sense. I need Starbucks to go a bit lower before I can start buying any kind of Starbucks shares, but they do pay out a dividend right now as well also. That's something that attracts me as well. I don't really have too many dividend stocks in my portfolio, so I'd like to add some, Starbucks being one. But at the current valuation, it just doesn't make sense to me. I can't buy it, especially when these Starbucks stores are going to be shut down. Like, it doesn't make sense. Now, if we look at the stock chart for Starbucks, where would I be thinking of buying? And look, I think Starbucks is going to have to get down in at least the 50s at the very least for me to start buying any shares. Right now, it's just too dang rich. And now we'll move on to the third and final stock, which I already own. I've talked about it already on this channel. It's Facebook, ticker symbol FB. Now, as at the time of making this video, FB is currently at $202.27 a share. And come on guys, you already know what Facebook is. They own Instagram platform, Messenger, WhatsApp, and they make money through the ads that are put on their platforms. People give them money to put their ads on their platforms. It's pretty simple. Now, I've already made a video why I think Facebook is a great company. I'll put it up there if you want to go and watch it, but we'll do a quick recap for this video, obviously. Honestly, Facebook's growth is ridiculous. It's approaching a $600 billion market cap, and it can still grow double-digit figures, which is ridiculous. When I say double-digit figures, I mean like double-digit percentages. Because of this rapid growth, you think their forward PE would be higher, right? Nope. It's currently sitting at what, 25, 27 or something ridiculous. I mean, come on, we're talking about a company that has $60 billion in cash just sitting on their balance sheet, and they just recently put $6 billion of an investment into a company called Gyro Platforms, however it's pronounced. But Gyro Platforms, it does look like it's the largest telecoms and internet service provider in India. So a massive investment for Facebook. It's just one of those monster companies that is expected to grow massively, and I think in the future it is going to be, if not the biggest one, or one of the biggest companies in the world. It'll be up there with the big dogs, Apple and Amazon. Take all of that with one of the best CEOs in the world, Mark Zuckerberg, and you'd think that this PE on this stock is ridiculous. Nope, it's at 27. Like, come on, this is a steal. So at what price do I want to buy Facebook at? To be honest, anything under $200 on Facebook is a steal, I think. I've already got some shares of Facebook. I own around about 10 shares of Facebook. Average price around about $180, $185 I paid. But look, even if it's sitting under 200, around 200, I am thinking about still putting more in. I'm hoping they obviously get around that 180 or less mark for me to absolutely load the boat on. But like I said, I'm already thinking about buying some more where it is right now. It's just a crazy company. So that's the 3 companies I'm looking to buy in this inevitable stock crash, guys, when it does happen. When it does happen is just a matter of time. We don't really know when, but I think it will eventually. But if these stock prices come down with that, I would be looking to load the boat on these 3 for sure. So like I said at the start of the video, guys, if you liked it, please hit like, click this little circle to subscribe to me. Look at that, I'm magic. And that's all I've got for today, guys. You have a good one.